I can, Corvin. Very nice to meet you. Thank you for joining us today in this holiday market environment.
Same. Thank you very much for your time.
So I was reading your bio, and it almost sounds like you were an astrophysicist, string theory, black holes, kind of like a Hawking character. How did you end up in trading from string theories and black holes? I know that some people early in their career, Corvin, trading is like a black hole. So did it prepare you for that?
I think you're absolutely right. It was my son's godfather who brought me into this, and this was late 90s when the internet bubble took off, and a lot of people in the maths departments, economics departments were speculating themselves. And he was also a professional backgammon player, so everything to do with odds and betting, he was on top of it, and he really introduced me and then made me read Jesse Livermore's biography, Reminiscences of a Stock Operator. And that got me hooked because trying to decipher the markets, at least from a mathematical point of view, is not too dissimilar from trying to figure out how the universe works. It's just a different universe with different components, but trying to find the underlying laws or rules that make things tick is very, very interesting.
Yes, and Martin Armstrong, pi, golden ratios, the harmony of the universe playing out in patterns in the market, different cycles, lunar cycles. Right? I mean, we're going to have a full moon on Christmas. That's kind of rare. Changing of seasons. Here we are at the solstice. So I see that in the market, that the market is really a reflection of what's happening in the universe harmonically, and Gann saw it that way too. All the masters did, don't you think?
I think it's very easy to dismiss a lot of this stuff, and I think the people who are truly good about making money in the market keep an open mind to everything, which actually makes me recall the PBS broadcast from I think '86, '87. That documentary about Paul Tudor Jones, trader, with Paul Borish at the time. And what's remarkable, he made a lot of money in '87 when the stock market crashed, and the way he did it was to overlay the 1929 market on top of the '87 market and forecast that it's going to crash.
Fractals.
Of course, if you come from a statistics background, you see that that's what they call a spurious correlation. So to a certain extent, you could say that he was pure blind luck that he actually made that call. And that goes back to what I said. You have to be very open-minded about lots and lots of different things.
So tell us about the beginning of the journey. I know you have some experience trading at different banks. And besides reading the books and I believe it was your son-in-law that introduced you to this, what were your major influences in the beginning stages of your trading career?
So I actually joined the financial industry 1 week before 9/11, and that was quite a turmoil as well because the banks at the time then massively shrank their equity departments, fired a lot of people. It took maybe 1 or 2 years for things to pick up again. That's how I got into the hedge fund business, initially developing systematic trading models. And the biggest influence at the time was The Market Wizards, the 2 volumes by Jack Schwager. And what's remarkable about the books, I've now probably read them more than 100 times each over the last 15 years, you always discover something new. I'll give you an example. If you look at the excerpt with Richard Dennis, who is the founder of the Turtles and the Turtle Trading System,
right.
Clearly in there already says towards the end of the 80s that moving averages, or over the medium term, 20-day, 30-day moving averages, just didn't seem to work anymore. And certainly over the last 10 years, you've had the situation where markets have become very choppy, unlike the 70s or the 80s. And he goes on saying that you either have to look over very short time horizons or extremely long time horizons. And that was very prescient because if you look at the way you'd formulate a trend following system nowadays, you definitely have to overlay a very long-term view and only trade with a long-term trend. And it's remarkable because that book was written in '88, '89, and so you keep on reading and rereading. For instance, the interview with Monroe Trout, who founded Trout Investment, and then of course there's now Tewksbury Asset Management, and they've had a realized Sharpe ratio in excess of 3 for the last 25 years. They make a very clear statement: execution is what's key. I mean, they can effectively implement trading systems that most other people can't, because they had the relationships with the floor brokers, so they could reduce their cost by 60, 70% and make money. And it's interesting because if you talk to high-frequency trading firms nowadays, a lot of their juice, maybe 80% of what they do, comes out of efficient execution, out of being connected to banks, seeing liquidity that others don't, and being able to implement their signals much faster. So those two books really put me down the path of, first of all, believing that it is possible to extract value out of the markets, and then setting a framework for how you do it. And that's more or less, you have to test everything, no matter how crazy the pattern. And I think Vic Niederhofer was also a very great influence. And he, of course, spawned Trout, and he spawned Toby Crable, who now runs Crable Asset Management in Milwaukee, very successful fund. And Victor Niederhofer effectively just looks at everything. I mean, you know, how does the S&P move on a day that has a W in it? How do stocks behave after the Fed if they start with an X? Anything under the sun that you can think of, you can test and test historically. And any pattern that seems to make sense and seems to work, that, you know, you should then forward trade it and implement it. And I think.
So how do you narrow it down? How do you narrow it down, Corvin, so that your head doesn't explode? You know, I mean, you know, I suffer from information overload. You know, people are always sending me, Dale, what do you think of this, that? I'm looking at this, I'm watching this. How do you narrow it down and filter it out so that you're not overwhelmed?
You have to be a bit single-minded and bloody-minded about it as well, in terms of just shutting out the outside world. You're absolutely right. If you start to look at everything under the sun that people recommend or people suggest, you're never going to get anywhere. And I think the problem with that is you're going to start going down routes which are just not compatible with yourself. It took me a very long time to go out of the very short-term trading mentality into the longer-term trading mentality, holding positions for in excess of a week. And that just wasn't me. I had to do it for various reasons, but it took a long time to do so, which meant that I did lose money on these kinds of systems. But that goes to show that you should be bloody-minded about what you're interested in, what you want to focus on, and just go down that route. I mean, in the end, there are a million and one ways to skin a cat, and trying to pursue everything is just not going to be fruitful. And in the end, I think the other truth to the matter is it's not that difficult to find something that will make you money on a consistent basis. It's about the discipline of sticking to it. And of course, going back to Richard Dennis, he stopped trading in '87 other people's money primarily because he lost a lot of money not being disciplined, not following his own rules as he had set them out in the turtle trading system.
Do what I say, not what I do.
Exactly.
So, Corvin, I want to switch gears a little bit here. With your views, I know you trade price action, but do you have biases? Say, for example, here we are at year end and a lot of books squaring low volume, high volatility markets, not the best trading environment. As you look ahead into 2016, does your work give you any cues as to whether or not King Dollar, which was disappointed by Draghi and so far has not been able to satisfy the parity bears in euro, anything that you're looking ahead towards in 2016 that is it going to be a repeat or a reversal of 2016's price action?
That's an interesting question. And it's, of course, year end and the price action at present is going to be very difficult to interpret. The one thing that I tend to do and really believe in is to look at how price behaves at the start of a period. So I think if you wind the clock back towards 2015, already within the first couple of days of January, you saw heavy dollar strength, setting of ranges for a lot of the majors against the dollar that you were then able to trade appropriately for the rest of the year. So my attitude right now is put on the brakes, wait for the first 2-3 weeks of January and see what the market wants to do, especially now that positions have been squared up. There's going to be, again, a lot of inflow of cash, putting positions back on, trying to make money for the start of the year to have a buffer, and that's going to show the market's hands quite clearly. To my own belief system at the moment, I think the dollar story certainly isn't over. It was very interesting when on Wednesday, the Fed announcement came out. The market just didn't move, which is so contrary to what a lot of the people in the market was. I mean, a lot of people were thinking that they'd see a repeat of March where we had like 400-point move in Eurodollar, and that just wasn't the case. So it goes to show that the story probably is not so much with the Fed as probably with the other central banks. I mean, we saw Kiwi starting to rally post the announcement that they didn't really forecast lowering interest rates any further. We are seeing Eurodollar now starting to halt against the 109.50 level, probably starting to sell off at the start of the year. So I think the focus will shift from what the Fed is doing, given that the market has priced it in so well, and move over to understanding if Draghi is allowed by the Germans to continue his easing and what the other central banks are going to do. And I think there's also a lot of action on the crosses if you look at Sterling Aussie or Aussie CAD and Kiwi CAD. And of course, let's not forget Dollar CAD that's just posted phenomenal returns in a straight line, up almost to 140 at present. So it's a combination between looking at what the central banks are bound to do versus the dollar, as well as just following the trends that we're seeing into the market and probably not being so fixated on the dollar as more on the crosses.
Interesting. So I've heard of that technique. I forget who really popularized it. I don't know, maybe it was Mark Leibovitz, that he took each day being a trading period for the year, the first week of trading after the new year. Can you expound on that?
I think that's not just applicable for the year. So for instance, if you take the first couple of days of the month, that'll set range. Or even for the week, take the trading range for the first 12 hours of the week. That'll again set a range which you can then trade in terms of a breakout once flow starts to happen. And it's also true for the day. Look at the opening range that's set by the individual markets. And of course, FX being 24 hours, the opening ranges are really determined by the European range and by the New York Open. So that'll be 8 o'clock London time in the morning and then 2 o'clock in the afternoon London time, so 9 o'clock Eastern Standard Time. So you see that pattern repeated over and over again. And if you believe that markets are, in the end, driven by flow, each of these has relevant flows, again, that affect it. So, for instance, on a daily basis, you'll have jobbers and voice traders having to put big orders from clients, from corporate clients, through the market. That'll therefore set the trend of the day if the market runs away from them, and you'll have an explosive trend one way or another. Again, month end or month start flows have an important impact for big real money clients, such as pension funds who have to rebalance their books, or corporates who have to hedge flows from overseas, and that goes on and on. And I think on every scale, the start of the period definitely will inform what happens for the rest of the period. But it's not just for the year. It's definitely also true for the month, for the week, and even for the day.
So are there any fundamental events? I'm talking Fed, Geo. I believe I talked about the fact that there could be some depegging from the dollar from emerging market currencies being under pressure because of what's happening with the dollar. We saw depeg. I can't even pronounce the country. It's in Russia. Azerbaijan. And I've asked people if they think that the Saudis may eventually have to come off the dollar peg. Are there any kind of fundamental events that you can see? I believe you could see it technically developing that could foreshadow what might happen in 2016. And isn't it a little too obvious just to be bullish the dollar and bearish the euro because of the fact that we're in a tightening mode and they're still in an easing mode? I mean, this is an old story to me. So can that old story of the interest rate divergence or central bank divergence between the ECB and Fed be a bit played out here?
I think you're right, and definitely there's probably something to be had within emerging markets. Before I get to that, even if you look at the euro, and just underline what you said, if you look at it on a purchasing power parity adjusted basis in terms of just the value of the currency, it's more or less in line with its long-term trend. So a lot of the majors are not too overvalued or too undervalued, maybe with the exception of the Swiss franc and the yen. So I agree. Are you going to see any big swings on the back of the information that's flown into the market? Probably not. It's very difficult to forecast, and that's why I say wait for the price action to confirm that in the new year. However, in the emerging markets, I think you do definitely have a very strong commodity story. I mean, we still have to see exactly what happens to China growth. That'll have an impact upon demand and upon all the emerging market currencies as well. And of course, the battle for oil between the U.S., OPEC, Saudi, and the fact that it's now being driven down to $36, and of course that strong correlation to the ruble that's completely knocked it out of whack. And then you've had dollar ZAR, the South African rand, just now more or less doubling in a year's time. And that was a phenomenal move. So yes, definitely, if you want action, if you want strong trends, emerging markets, it's where it's at, especially because the story just hasn't played out there in terms of what's happening to growth. And maybe on a minor scale within G10 currencies, people still see some growth, some potential. The S&P hasn't really fallen off from 2,100. In the other markets, it's been more or less a catastrophe for emerging markets. And so is that going to spill over at some point and create correction down the line in the other markets? That's still to be seen. I think that's a definite possibility, and therefore emerging market currencies should be a great play for that.
And gold has a heartbeat lately. That 1040, 1050 level, we've had a couple tests of that range, and we've come off acting much better than the crude oil market. Is there a possibility that this gold move is starting to mimic what the Chinese have done as far as accumulation of physicals and their entry into the IMF reserve currency status? Do you see any implications of what could happen with the yuan now that they're devaluing and almost looks like they're depegging from the Dow?
Look, that's a very interesting question, but I'm not an economist, so I'm not going to be able to go into too much detail here. But
Okay.
gold's been a very funny asset. No, I mean, it certainly has had a 20% up and down range this year, but it doesn't seem to know where it wants to go. And the interesting thing about gold going down so far, of course, is that gold tends to be very much an inflation-driven story. So does that maybe tell us that people just don't believe that inflation is going to pick up anytime soon over the foreseeable future, which then will have a big impact in terms of how banks will set their interest rates going forward? And of course, the very interesting thing is now with the Fed having increased rates, let's see if they come down the second time round. Will they at some point have their hand forced to reduce rates again? That, for instance, what happened in Japan several years ago, 5-6 years ago. So that, I think, is going to be very interesting to see if the economy is indeed as fragile as some people think, and a lot of the posturing that we have at the moment in terms of the economy growing is just not what it is.
So let's get to your wheelhouse. And I find it interesting that what you teach is trading is not only speculation, but to treat your trading as a business. So why don't you tell us a little bit about what your approach is to trading so that people can look at it as not a walk into a casino, but treating it as a business?
The most important part about a business is to understand where your growth is going to come from. And I think if you look at the equity markets, you look at the bond markets, commodity markets, people have a very good understanding that it's something that they can touch. And given macro policy by most governments and long-term growth prospects, these things are going to appreciate. So you purchase them, you sit on them, and money's somehow going to appreciate. So that doesn't seem to be the case within FX, at least at the surface, which means that it's very difficult for people to benchmark themselves. So within the equity markets, it's very easy for somebody to lose 10% on the year, but say, hey, the S&P dropped 15%, so I outperformed by 5%, so I'm doing well. So is there something equivalent in the FX markets? And that's been a big debate over the last 30, 40 years, especially after currencies depegged from the dollar. You had a freely floating market since 1974. And the analysis, certainly over the last 40, 50 years, shows that indeed there are fundamental driving factors for FX that allow you to create an index that shows long-term growth prospects. In essence, you're buying a basket of currencies versus the dollar, let's say, and what you're doing by rebalancing amongst these currencies, you're exploiting the divergence between the economies over monthly, bi-monthly, 3-monthly levels. And what you tend to find is that these indices, which are quite easy, these benchmarks, which are quite easy to create, have performances very similar to the S&P. So, in essence, approaching it as a business makes you ask, where does the growth come from? And you identify several underlying factors, such as the notion of the law of one price and value of a currency, interest rate differentials, which make investors look for the most appropriate rate of return, as well as short-term flow, which drives momentum. And by combining these in straightforward ways, you create an index that has value over the long term. So you're stepping away from this idea of a zero-sum game, in essence, as you described it, a casino. Once you can do that, you in essence are saying, hey, I've got a strategy, I'm exploiting something that's fundamentally there on the basic level. Can I then trade around that? That allows you to become slightly more complex, but at least you have a fundamental benchmark, an idea as to where your growth comes from. And that's quite important because a lot of people go into the trading business and imagine that, hey, a good trader makes money almost every day. And that's not quite right. I mean, let's take some of the biggest hedge funds out there, such as Brevin Howard, which had a down year for the first time last year, and it's been pretty flat for the last couple of years. So even the best guys out there don't make money. And so the most difficult thing it is to understand, should I be confident about my performance? And if I just don't know how to measure that, I'm not going to go anywhere. I don't have a roadmap. So a classic example, of course, is everybody quotes Buffett. He's a great investor. Of course he is. But even he manages to have 50% drawdowns. And you just have to pull up a chart of Berkshire Hathaway from 1998 and just in the 2000s as well. And he's always managed to recover. But he was able to withstand those 50% drawdowns because he knew, or he had this historic perspective as to where he stands and what he has to expect. And similarly, by going into FX and having a benchmark, having an understanding as to what the drivers are for long-term growth, allows you to say, hey, you know, I have a 20% drawdown this year. It's not too bad. I understand where it's coming from and that I shouldn't be too surprised about it. And I think that's what happens to people. They go into this business, they don't understand what the downside potentially is. They experience it, and they think it's the end of the world. They chase something else, and of course they just keep on losing money rather than saying I should stick to my guns. It's something that I should expect of this business. And you know, every business is cyclical, and it's not sufficient to just say, hey, slap a moving average on top of it, because as we've already seen from the 80s until now, the structure of the market changes in terms of this kind of technical flow, but in terms of fundamentals, it'll continue to produce over the long term, and that's what you have to understand. And that's what I mean by a business. I mean understanding what are the driving factors that allow me to make money over the long term.
Well, perhaps FX isn't the greatest asset class to have this with. I've talked to e-waivers that say when you come to equities, you see more impulsive, more conventional Elliott type patterns, and Elliott was developed not on the euro dollar that never existed back there, but based upon a wave structure in equities. And his thesis is that almost everything in the FX market is corrective because it's a central banks battling each other or cooperating with each other. So there are more corrective moves in FX than there are impulsive moves. So perhaps FX may not be the best asset class for having that type of benchmark because of the corrective nature of it. You see any validity in that?
I certainly, what you've seen over the last couple of years with interest rates being uniformly low, that the risk premium has been squeezed down. It's been difficult to make money within FX, especially because daily ranges were squeezed out by the middle of 2014 and have since then come back a bit. But that's true for other asset classes as well, and that's why I think you've seen macro funds not do very well in the last couple of years. It's effectively not just FX as an asset class that suffered recently, it's just reducing interest rates to zero has made it very difficult for people to find risk premium for which they can get paid. The interesting thing about FX in terms of, as you said, corrective, and also the fact that these things don't tend to be explosive like a Yahoo stock that goes from 3 up to 100. They tend to go in waves, but these waves are usually out of sync. Now, that hasn't been the case for the last couple of years with this very loose monetary policy, but we're seeing a divergence starting to come up. And so my expectation actually is going forward is that with increased volatility, with divergence amongst the different countries, you'll see more potential for these currencies to move against each other and for continuous rebalancing to actually extract the juice, which is the essence of a lot of these FX benchmarks. So in part I agree, up to now it's been difficult. I, however, think going forward it's going to start to produce again.
Okay, and how about the issue of liquidity, which has shown up in FX markets from time to time, and the bond market definitely not as liquid as it was a decade ago, where you could get trades off, bid offer, but 30-second. It's not that way anymore, and some concerns about reduced liquidity in FX markets, especially on red event days like the Fed or NFP. How does that factor into what you do and treat it as a business? As a businessman, I would not trade those days. How about you?
If you just focus on trading intraday during those days, I completely agree. Just stay out. And we saw it on the Fed. I mean, within that minute, euro dollar spanked around in the 100 pip range with bid asks being all over the place. It's getting more difficult, and I think the reason is that the facilities or the exchanges for FX have focused more and more into very centralized places. There's not as many players as there used to be, and obviously, given that it's not a regulated market with one centralized exchange, a lot of people decide to take risk on or off as they choose. And given that you can't diversify your risk as easily within the interbank market, then people will just do exactly that, pull liquidity exactly when you need it. Over the longer term frame, however, if you're trading weekly or even monthly holding periods, it's not going to affect you. I mean, a daily move of 100 points in the market is healthy. So it's really about your time perspective there. But I just would not trade news at the moment, and we saw it not just with the Fed announcement, but with the NFP at the beginning of the month, which was pretty hairy as well. So the best thing is to switch off before and switch on afterwards. And this is something that the banks and the brokers do as well. They either widen out their bid-ask spreads or they just stop quoting pure blank if they're second tier.
Okay, I have 2 questions to wrap it with. What's your view on leverage? I wrote a song, use less leverage when you trade the markets, use wider stops so you don't get picked off. If you don't use less leverage, you might lose your head and your account may be dead. What kind of leverage do you teach people to use, Corvin?
During news announcements, very low leverage. It all boils down to risk preference. And again, Kelly betting is really the theme that comes to mind, and it's something that is used by probably the most successful hedge funds out there, from Medallion to Tiger to even Warren Buffett and George Soros. And the essence is that if you know you're on a winning streak, you need to leverage yourself up. The question is, by how much? Of course, that will be only determined by how good you are. Personally, I will have trading systems that run on 10 times leverage on various positions. It can go even up to 20 to 30 times leverage. But that'll be during quiet market periods where I know that my stops won't be violated, because if you have something like a Fed announcement, NFPs, where you just don't have liquidity, I can guarantee you're going to have a 20-30% drawdown on your capital. Leverage is something that's a two-edged sword. It's a blessing in disguise because you can make a lot of money very quickly, but you need to know when to apply it.
Okay. And I get this question a lot, perhaps you do, from people that you teach with your course. They go, Dale, how much capital do I need to trade for a living? And the typical guy says, can I make a living with 10K? And I say, yes, if you want to live beneath an underpass. How about you, Corvin?
I was going to say exactly the same thing. It's one thing, can I make money with starting out with $100? And the answer is a definite yes, especially nowadays where you can trade micro lots and the bid asks are quite narrow. But can you make a living? It depends how much expenses you have. If your expenses are low, guess what? It doesn't matter. I think you have
a cardboard box under an underpass.
Well, I'll tell you, I think
you won't feel the pressure to make money.
The biggest issue, look, and this is why people also have IRS, and in England you've got something called ISAs, not the IRS, but all these tax havens for, like 401k, I think the plan is called in the States. The reason you have these things is because you don't get taxed every year. The government doesn't take a percentage of your profits. So why would that be good for you? Because your exponential growth, because of your compounded interest, is so much bigger. So what we're actually saying is, by thinking about your trading assets as income generating, you'll never grow them to any significant amount because you're just skimming off the top and you're not allowing the interest of the interest of the interest to accumulate. So you shouldn't think of trading as making income, find a job, find something else. You should think of trading as making your money just exponentially grow right up to the sky. And that means you shouldn't really touch it.
Okay, and that makes me think of Rich Dennis, because you talked about he's a legend. He made a lot of money in the markets, and then you talk about that drawdown year and afterwards he stopped trading. I believe he thanked God that he had C&D Commodities, which was a clearing operation for floor traders on the CBOT, that it's wise to have more than one revenue stream, and even the greatest traders in the cosmos had more than one revenue stream, meaning their trading account.
But why do you guess hedge funds charge 2% a year on management fees? They charge 20-30% performance, but they still charge 2% because they just don't know if they're going to make it or not.
A better question is, why do hedge funds close after they're down 20% and they can't hit their watermark and then reopen under a different name?
Well, because you just said that, because when they reopen under a different name, there's no high watermark.
Corvin, what's the best way for people that have seen you, heard you today, to get in touch with you? And perhaps you want to just take a few minutes to talk about your Twitter handle is at FX Master Course, so I assume that's the title of your course, FX Master Course. Is that correct?
It's also the it's fxmastercourse.com, the address of the website. The purpose at the moment really is to. I love trading. I love thinking about trading systems, and I love writing about it as well, which also leads naturally to teaching. So this will expand with time, and there will be lots of information to be had, which I think will be useful to people. On the website and by the Twitter handle, people can get in touch with me. At the moment, I'm really thinking what the best format is for engaging with people. Previously, it's been one-on-one in terms of coaching, seeing people through the initial phase of understanding the basics of the course, and then having contact with them over a 3 or 4 month period afterwards to see how their portfolio is going. The primary purpose here, of course, is also very selfish. Having or running a hedge fund means that you more or less stare at the screen, and it's a very solitary business. The teaching environment allows you to create contact with people who usually are quite talented, because it takes a lot of oomph and chutzpah to be able to just go out and do something as difficult as trading. So yeah, please do get in touch via my Twitter handle or the website fxmastercourse.com, and any kind of relationship, bouncing of ideas. As I said, I'm going to continue to produce content and material for people that will be useful for them to trade or set up a trading environment for themselves. And if anybody is interested in a one-on-one course, then we can definitely take this further.
Well, Merry Christmas, Corvin. Thanks for your time today. Happy New Year, and may pips chase you and your mentees down in 2016.
The same to you, Dale, and thank you very much for your time.